The difference between poor people, middle class people, and wealthy people is not how much money they make. He said the difference between poor people, middle class people, and wealthy people is what they think the purpose of money is for. Poor people think the purpose of money is to give it away. So they make just enough money to pay all their bills. Middle class people think the purpose of money is to buy things that they can't afford to impress people that they don't like. So they buy expensive cars, buy expensive houses, and put themselves in debt. Wealthy people understand that the only purpose of money is to use your money to make more money, period. So they take all their money and they invest it in assets. Then they borrow against those assets, tax free, and then live off that. And then they buy life insurance and then die and then repeat the process. But what do you think the purpose of money is for? Is going to keep you rich or keep you poor?
All right, guys, welcome to another episode of The Report. Today, I got a couple guys that specialize in tax strategy, business wealth management, and doing big things in their prospective spaces. I got Carter Caufield and my man, George Acheampong in the building. Carter, George, welcome to the show, guys.
Thank you for having us, brother.
Happy to be here, brother. Long
Yeah.
time coming.
I know. Been wanting to connect with you guys for quite some time now, and excited to finally talk shop, man. A lot of stuff to cover here. But first things first, out of curiosity, what is one tax loophole that you guys are utilizing today that most people wouldn't know about?
It's called the self-rental strategy.
Okay.
So a lot of business
What's
owners.
the self-rental strategy?
Yeah. So a lot of business owners make content just like you, right? And they invest in a content studio. What most people don't realize is that if you buy a building that you turn into a content studio, you can get 179 in bonus depreciation on that building via a cost segregation study. So we can buy, let's say, a $500,000 studio that we need to buy anyway to create content. And without having to get 100 hours, without having to be a real estate professional, I can do a cost seg study and write out up to 30% of that building. So I get $150,000 tax deduction for getting a content studio that I need to get anyway to grow and scale my business. And most people are not talking about this because they don't realize that you can do this strategy without the 100 hours, without being a real estate professional, and without having quote unquote material participation.
Dude, I love that idea. I've heard of the self-rental strategy, but I've never heard of it in this light. Because you're right. If you're a business owner, real estate investor out there, you should be putting out content. You need a content studio. And then this is a perfect way to use that write-off.
Yeah. It's a very smart way to utilize it. And it's something that business owners need to do, but it's not going to take you away from what your core business is, which is like, we have to be a real estate professional. Like it takes a lot of time, effort, and energy, but that's one of the strategies that we're using. Anything else?
Yeah, for me, and I know we'll dive probably deeper on this later, is the buy, borrow, die strategy, right? The best way to minimize taxes.
What is the buy, borrow strategy? What does that mean?
The best way to avoid paying taxes is not paying them at all, right? So you invest your assets. Let's say, in my case, I'm investing into a portfolio of stocks, ETFs, et cetera. And at some point in time, I can borrow against that portfolio. And because the IRS does not recognize borrow money as income, all that money that I borrow is not taxable. And I can use that money to live my life. I can buy other assets. And so that's one of my favorite strategies, is simply leveraging my assets to get access to capital without having to pay any taxes at all.
Got it. So it's called the buy, borrow, die
Buy,
strategy.
borrow, die strategy.
Carter, anything to add to that one?
Yeah. So the buy, borrow, die strategy, what I love about it is, number one, you need to buy assets, which most people need. The goal of active income is to use active income to buy passive income, period. Right? So once you buy assets, as those assets grow up in value, you now have equity, which is the difference between what you purchase it for versus what it's worth. And you can borrow against the value of that equity and pay no taxes because, as George said, borrowed money is not taxable. But people say, well, what happens when you have all these loans as you get, later in your life? Well, that's why you buy enough life insurance to cover the outstanding debt that you have on your assets, so that when you die, not only are you passing down tax-free money because life insurance proceeds are tax-free, but your kids can use that money to pay off the debt. So now you're passing down debt-free assets to your children as well. And you're probably familiar with the step up in basis. So now my kids are going to get the asset with a step up in basis, meaning they're not going to have to pay taxes on the gains from it, but they also get the asset debt-free.
For those that are not familiar, what does the step up basis mean?
Step up in basis means that, let's say I buy a property at $100,000, and by the time I die, it's worth $1 million. That's $900,000 in capital gains. And if I pass that asset to my children while I'm alive, I'll also pass down that $900,000 in capital gains, which would be a $180,000 tax bill. But if I set it up right with a revocable living trust, I can they will get a step up in basis, meaning they will inherit that property at the fair market value of $1 million at the date I die. So if they were to sell it the next day, it's worth the million. They sold it for $1 million. It's no tax on that money, which is called a step up in a basis.
Yeah, absolutely. And in addition to the life insurance policy to pay off debt if you were to pass away, I mean, if you're using debt to buy real estate, most markets around the country, real estate typically goes up over time. Your debt payment stays fixed, and so over time, you should have more equity than you owe on that mortgage balance. What is the difference between a revocable living trust and an irrevocable living trust?
Yeah, so revocable living trust, the primary purpose of that is to delineate where you want what you want your assets to do, right? I want my kid to have this house, I want my daughter to have X, Y, and Z. The primary focus of an irrevocable trust is to potentially mitigate taxes, right? Because there is going to be a certain threshold where if your estate taxes are too high, right, you're not going to be able to minimize those taxes. So with the irrevocable trust, you're basically saying, I have so much wealth, I'm willing to earmark these assets that I will not have access to. I cannot change it, hence irrevocable. And then that's going to give you some tax and asset protection, right? And so that's typically going to be a better fit for people who know that their estate is going to be over a certain threshold, like let's say north of $20 million, right? If that's the case, that's going to be a better bet for you. For the average person, I believe you can get by with the revocable trust because your primary objective is I want to make sure that these assets I'm passing down are going to get to who I want them to get to. And if I'm passing them down to younger children or things or things of that nature, I want to make sure that they're not messing up the money, right? And I can dictate and control from beyond the grave, so to speak. And so those are kind of the two primary differences is do I need to mitigate taxes because of how much assets I have, maybe irrevocable trust is a better bet. But if your primary focus is how do I make sure that the assets I have get to who I want them to get to, then irrevocable is probably going to be the best.
I think a lot of folks think living trust is for like old people to set up,
No,
but
absolutely not.
who is the right person to set up a living trust?
Yeah. So, I mean, arguably most people, right? Because if you have minor children or anybody that you care about, if you have causes that you care about, not to mention your trust is going to also include your medical directives, right? That's something that people miss. It's like if you get temporarily incapacitated, if you get hurt or sick, you want to make sure that people know how to carry out your wishes. You don't want anybody making decisions on your behalf, right? Without you knowing exactly what's happening. So, arguably, I would say 99% of the population. Now, granted, if you have absolutely no assets, you have no children, no causes that you care about, maybe you don't need a trust. But if that's not you, then I would recommend a revocable trust for most people.
Yep, that's really good. What is the placing children on payroll strategy?
Yeah. So if you're a business owner, you can place your children on payroll. You can get a tax deduction and your kids can receive the money tax free. So the way it works is that you, number one, want to hire your kid. You want to give them an actual role in the business. Now, the best age to do this is between 6 and 17. If they're younger than 6, can you hire them? Yeah, but can a 6-year-old do actual work in your business? If they're over 17, you can still pay them, but that money won't be 100% tax deductible. So between 6 and 17 is the sweet spot. You can pay them up to $15,750 in 2025. You get that write-off and your kids receive the $15,750 tax-free. And if you're a smart parent, you won't give all the money to that children. You'll take 7,000 of that 15,000 and set up a custodial Roth IRA for them. So now you got a tax deduction for paying your children. They receive the money tax-free, and now it's going to grow tax-free forever in their custodial Roth IRA. So we avoided taxes 3 times on the same dollar.
I love
Yeah.
that. And what is the backdoor Roth? What does that mean?
Yeah. So with the backdoor Roth convert, essentially, like at a certain income threshold, you can't contribute to a Roth IRA, right? But it doesn't mean that you can't have a Roth IRA because there's limits on contributions for retirement accounts. Like you mentioned, 7,000, but there are no limits on conversions, right? So if you have an old 401k from a previous employer and you're a high income earner, you can convert 100% of that money into a Roth IRA, right? And what that is going to allow you to do is be able to essentially backdoor your way into having a Roth IRA, even if you're phased out from an income threshold, right? And the reason why we love Roth IRAs is because most people don't realize with traditional retirement accounts, the money goes in on a tax deferred basis, meaning that when you actually want to use the money, you're going to pay taxes in retirement, right? But when the money goes into a Roth IRA, it comes out and is distributed on a tax free basis. So at the point in which you want to retire, now you don't have to worry about paying any taxes because you've already paid the taxes on the money. So we want to convert as much as we can into the Roth IRA so that we can have that tax-free money when we actually want to use it.
Yeah, I like that. When I got started in the real estate game back in 2019, I was a 11-year air traffic controller for the FAA, and I had a 401k. And so I actually cashed out that 401k in 2019 to get my start in real estate investing, and that was my seed money to do my first couple deals. That's kind of how I learned the game. But it was a traditional 401k and through the TSP, and so I had to pay. It was taxed as ordinary income when I pulled it out. But the cool thing is depending on when you pull it out, you might not have to pay those taxes for a little bit. And because I had left the air traffic control career and I became a full-time real estate professional, the depreciation from a cost seg study on the real estate that I acquired offset a lot of those income taxes that I would have paid. And so I think depending on when you pull it out in the year, you can strategically set it up correctly to where you can lower your tax burden. So that's kind of how I got in the real estate game myself. Do you guys believe in going Roth or traditional at this current time? If someone was employed and let's just say they had a 401k and their employer gave them the option of either.
Yeah. I don't think either one is wrong, right? I think it's both. And because when you think about it from a tax strategy standpoint, like maybe it does make sense to decrease some of your tax liability today, right? And so, but we're not just putting 100% of our money in the traditional IRA. I want my clients to focus on not just climbing the mountain, which is the wealth accumulation phase, but also how do we get down from the mountain, which is the distribution phase. And so maybe we're having a hybrid strategy where it's like, hey, we look at all of our different options. We're going to put this percentage into the traditional IRA, but we're going to put this percentage into a Roth IRA. So we look at the total amount of money we need retirement, we'll still have more. So for example, let's look at two clients, all things remaining constant. Client one needs $100,000 of income from their retirement accounts when they retire. If they have 100% in the traditional IRA or 401k, let's just assume they didn't meet you, they don't know about cost segregation studies, and they're paid $30,000 in taxes, they net out $70,000 in income. Over the first 20 years of their retirement, they're going to pay $600,000 in taxes. Person B or client B still needs that same $100,000, but $50,000 is coming from a Roth, $50,000 is coming from a traditional. They're only going to pay, let's call it $10,000 in taxes a year, and they're going to save over $400,000 over that same 20-year time horizon, right? And on top of that, they're getting $90,000 a year in income versus the $70,000. So I don't think it's an either or. It's just a matter of how do we couple it to make it make sense, minimize some of our tax liability while we're working, and then minimize more of our tax liability when we're not working.
Yeah.
I actually like retirement plan stacking. I don't think enough people talk about
What
that.
is retirement plan stacking?
So you can have a traditional 401k that's tax deferred, and you can stack it with a Roth IRA that's tax free, and you can stack it with the HSA that's also tax free. So I can have, a money in my traditional 401k account. I have money in a tax free forever Roth account, and I have money in a tax free forever HSA account. And most people think they have to choose between these accounts where they can actually stack them together every single year because the contribution amount is in total, not in aggregate.
And what is a HSA account?
A HSA account is an account that has a triple tax benefit. You get a tax deduction for the money going in, the money grows tax-free, and as long as you use it for medical-related expenses, it's tax-free forever when you take it out. The thing that most people don't realize is the vast majority of things the IRS considers to be HSA eligible. You can get your prescriptions paid with your HSA. You can get certain elective surgery, veneers, all these things that people don't think they can use HSAs for, they actually can. So
you get hair transplants too in Turkey?
Yeah, I believe that's on the list. Yeah, I believe that's on the list. Yeah. But you can use
breast
HSA.
implants too for females?
Need to double check that.
Okay. You're talking veneers.
Depends
on
upon
like,
the
this is
career.
cosmetic.
Depends
now.
upon
the
yeah,
career.
depends upon the nature. But the HSA eligible expenses are vast, and most people don't realize it.
Speaking of Roth IRAs and traditionals, you can take loans and borrow against your IRAs. I had Karen Hall on, and Karen was talking about how she had a client borrow against her Roth. I'm sorry, it was a self-directed IRA, and she had a client take the self-directed IRA money to invest into Super Bowl tickets. And then resell them in the open market, made a return, and the returns went back into the self-directed IRA and continued to grow tax-free. I thought that was pretty unique.
Yeah, I did see that clip with the Super Bowl. So
yeah, I didn't know that was legal.
Yeah, so the thing with the self-directed IRA is you can use it for anything, right? And so all that buying a Super Bowl ticket and reselling, that's just a reselling business. So you can
Yes.
absolutely buy and sell Super Bowl tickets. You can buy and sell cars. You can, Peter Thiel has a, was it $5 billion
$1 billion Roth
Roth
IRA.
IRA because
Yeah.
he bought the shares of Facebook and then resold them inside of his Roth IRA. So that's why self-directed IRAs and self-directed Roth IRAs are tools to exponentially grow your wealth if you know how to invest that money.
Right.
Because the same fire that can
Keep a house warm.
keep a house warm can also burn it down.
Yeah, because there's rules, right? Like the way I like to explain to people is like if you go apartment shopping,
Sure.
right? There's an apartment that has the really nice, huge walk-in closet, but then the kitchen is small, right? Or vice versa, has the beautiful kitchen, has a small closet. The way the IRS sets up these different accounts, these are just IRS tax codes, right? So with the self-directed IRA, it's great, but if you're looking to benefit from the cash flow right now, it's not going to be the best vehicle for you, right? But if that money in your mind was locked up anyway, but I want to diversify how I can leverage that money to invest, i.e. buy Super Bowl tickets, i.e. invest in a hotel, or whatever the case may be, great. I just have to be okay with the proceeds going back into the account if I'm not 59 and a half, right? Now, if it's a Roth, different story. But ultimately understanding how the provisions of the accounts work, because with the self-directed IRA, you're not technically borrowing against it, you're borrowing from it. And we can make that distinction later on in the episode, but borrowing from something means if I have $100,000 in it, I borrow $50,000, great. I can use that $50,000 for whatever I want, but my current account value now is $50,000. If I borrow against something, my account value remains the same relative to market fluctuations, but I'm essentially leveraging that asset as collateral, and then that same institution is giving me a line of credit to then go invest in other things. That's the key distinction that I don't think people always know.
I love it. I love it. How do folks typically write off G-Wagons, Bentley Bontegas, Rolls-Royce Phantoms, all these nice cars, even boats via Code Section 179? How does that work?
Well, here's what we're not going to do. We're not going to buy things that we can't afford just to save on taxes, right? And as much as writing off a G-Wagon and a boat sounds good, if it makes you broke in your business, I don't think you should actually do it. But the way that it works is that via 179 deduction and bonus depreciation, you can write off 100% of the cost of any asset or piece of equipment weighing over 6,000 pounds, which includes the G-Wagon, which includes a boat. It also includes a jet. As we know the story, Grant Cardone wrote off a $70 million jet against his taxes and wiped out his tax bill for multiple years. Now, these are great strategies if your business can afford them, because what we don't want to do is let the tax tail wag the dog by making you broke in business to save on taxes. And I think that in the world of social media, we just have to all understand that, can we afford it first? If so, let's make sure to leverage it to avoid paying tax.
Yeah, I hear way too many people getting into real estate investing, and they're like, hey, I want to buy this rental property to save on taxes so I get some depreciation. I was like, oh, how much are you making right now? It's like, oh, I'm making $70,000 a year. I'm like, dude, you don't have a tax problem right now.
Yes.
Like you got an income problem. You got to fix your active income first, and then go buy some real estate, then go get some depreciation. So Code Section 179 and 100% bonus depreciation, do those two work hand in hand?
Yeah. So the way the 179 works, I believe in 2025, you can write up to the first $20,500 via 179, and then the rest comes in with bonus depreciation. So most people don't realize that you can buy an asset that weighs less than 6,000 pounds and still get a $20,000 write-off via 179 deduction. So you don't have to buy a car that weighs over 6,000 pounds that you don't even like just to take advantage of depreciation. You can still get depreciation with assets that weigh less than 6,000 pounds.
Yeah, that's really good. That's really good. So I'm curious, out of curiosity, this boat that I bought, how would this work? So I bought it in 2025 this year. Calendar year is not over, but I bought it through a charity, a boat donation charity. I didn't even know that was a thing. But basically, like, people will donate their boats to these charity foundations. They'll get a tax write-off. And so this dude donated the boat to this charity in this case. He got a tax write-off. I want to say it was over $2 million was his write-off. The charity put a couple $100,000 into fixing up the boat. They sold it to me, 1.3, and they did a 36-month lease. You put 35% down, but each lease payment 0%, and it goes towards paying off the principal. At the end of the 36 months, I have the option to purchase the boat. I would be dumb not to purchase it, right? For the remaining balance, which I believe is 29% of the 1.3. Okay. So I essentially got a 36-month loan at 0%. put 35% down, and I got a boat at a massive discount. This thing brand new in 2021 was 3.5. I picked it up at 1.3. The dude that donated it, he's getting a big tax write-off. The charity, this is all profit for them. It's going to their foundation. But how does this work from a tax perspective at the end of 2025 when I go to write off this boat because it's a lease?
So you cannot depreciate an asset that you don't own.
Okay.
So if you're leasing a boat or leasing a vehicle, you can write off the lease payments and all of the expenses associated with you having that boat. But because you don't own it or are not in the process of owning it, you can't depreciate it until you are the owner of the asset. So with lease payments, people are like, can I write off my car lease? I'm like, no, because you're not about to own it. Now, if you take advantage of the lease to buy option, the year in which you convert the lease to buy option will be the same year you're able to take bonus depreciation, to my knowledge.
Got it. So the year that it converts from a lease to actual purchase,
Yeah.
that's when I can take the depreciation.
Yes, to my
And
knowledge.
that would go off the purchase price initially?
That should go off the purchase price because the purchase price is your depreciable basis.
Got it. That makes a lot of sense.
Yeah.
The good news is I don't need extra depreciation because I
The real estate, you gotta be.
I got more depreciation than I know what to do with. So
Yeah.
I don't need it right now, but maybe in 3 years I'll need it. So I thought that was kind of interesting. Now how do I write off the lease payments now? Because it's a marketing expense. I'm bringing clients out in the water. I'm doing meetings out in the water, business meetings, that sort of thing. Is that right?
Yeah. So as long as you are using the asset in the pursuit of income, right? So you have a mastermind program. You can charge more by adding boat trips as part of your offer. Say it was $20,000 before I had the boat. Now it's $30,000, but you get one yacht trip. That $10,000 increase would not happen without that yacht. That is proof to the IRS that this yacht is helping me in the pursuit of income for my business, which makes it ordinary and necessary to make money in your business, which would make a portion of that yacht tax deductible. And the portion is how many trips are you taking personally? How many trips are you taking business-wise? And if you take 10 trips a year, 7 of those are for business, 3 of those are personal, 70% of all those expenses, lease payments, plus fueling, plus all those other expenses are tax deductible to you, the business owner, and that will stand up in audit.
That's really good. So I had a private jet guy, Captain Kurt, on the podcast recently, and this guy brokers jets, and he said since 100% bonus depreciation came back, the jet market has heated up, and then by nature, end of the calendar year, everyone's trying to get depreciation, and so he said right now the jet market's actually pretty hot. Talk about, or what are the tax benefits of owning a private jet?
Yeah, I mean, it goes back to the fact that it's a piece of equipment that clearly is over 6,000 pounds, right? And so when you own that asset, and the good thing about the way the IRS works is even if you finance, right, that purchase, the IRS will still let you write off, right, the cost of the jet, right? So let's say that you're all in for 30% of whatever cost for a down payment. That doesn't mean that you aren't going to be able to write off, right, the total cost of the jet, right? And so obviously a jet can be a huge asset when it comes to being able to offset your taxes, being able to, fly for business, all of those expenses associated with that, just like with your boat, will all be tax deductible expenses on top of what it costs you to buy the jet. So it can be great. Now, again, it's not cheap. So if you can't afford the jet, let's not try to go buy the jet for the sake of a tax deduction. But if it's in the realm of your means and it makes sense for your business and you need the tax deduction, it can be an amazing asset to take.
Yeah. I know some guys that they can't afford to just have the jet sitting there when they're not using it, so they'll charter it out when they're not using it, and that kind of helps supplement some of the operating costs and that sort of thing. But then again, it's like, dude, you're renting this thing out, you're putting a lot of wear and tear on the plane too, which you got to take into account. So it'd be interesting to see how those numbers actually factor out when you account for everything.
Yeah. And what I love about what you just said, all the tax code is an incentive system. It's not a penalty system. And when the government wants to make people do something, they will make a change to the tax code to make consumers move, right? If the government wants us to go spend more money on automobiles, they will increase the deduction for automobiles. If the government wants us to invest in real estate more, they'll increase the deductions for real estate. So all the tax code is the government saying, if you have 2 choices: do what I want you to do with your money, and I'll give you tax breaks, or I'll take your money and do what I want with it anyway. The question is, what do you want to happen with your money? I would rather be in control.
Yeah. I hear Robert Kiyosaki say all the time, they tax the uneducated, the people that aren't aware, they aren't familiar about what's going on with the tax.
Ignorance tax is
the
the
tax
biggest tax you'll ever pay. Biggest tax you ever paid. The cost
Yeah.
of not knowing is substantial.
The government wants to incentivize certain things. High level, what are some of those unique things that you can get tax breaks on that a lot of people don't know about? Like agriculture, oil, talk
Oil
about
and
some of
gas.
those.
Yeah. Agriculture, oil and gas, film development, obviously purchasing businesses, purchasing real estate, because the government is lazy. They say we need these things to happen in the economy, but we don't want to do them. I don't want to farm. I don't want to build houses. I don't want to start more companies so that people can have more jobs. So whatever the economy needs that the government doesn't want you to do, they'll give tax breaks for somebody else to do those things. And that's why we have the tax code.
Because you got to think about it. If the government's job is to grow the overall economy, right? And so if it wasn't for small business owners, these are people that they'd have to employ, right? And so it's like, okay, well, how do we not employ all these people? Because the government is super antiquated when it comes to their infrastructure. They incentivize small business owners to do the work on their behalf. Like, okay, great. You're making affordable housing. You're doing this. You're doing that. And we're going to give you an incentive to do it, because if not, we would have to build the infrastructure to substantiate it so that our economy can grow. And when you look at it from that vantage point, that is why we say you have to be an entrepreneur, or you have to at least be an owner. Like, you don't necessarily have to be an entrepreneur, but you have to be an owner of assets that the IRS at least will incentivize you to own, so that you can get the benefit of the tax deductions and the tax.
You guys mentioned a write-off for film. What does that mean? Elaborate.
So you can invest in certain film projects and get a 4-to-1 on your investment in the film project, right? Now it has to be through certain IRS regulations, but there are film projects I can donate $100,000 to, or invest $100,000 in, and I will get a $400,000 write-off. Now at a 37% tax,
4-to-1.
4-to-1.
Mhm.
Damn.
Yeah, at a 37% tax bracket, that's your deduction will be larger than your investment, and you still can make money from the film project if the film ends up working out. Now, this is an advanced tax strategy. If you're not making at least $500,000 or more in profit, there's other things you can do with your money before investing in film projects that you don't know or understand. But you do have to get the 100 hours or more to substantiate that loss against your active income. But guess what you can use your 100 hours doing?
What's that?
Watching movies. Because that's
Mm.
research and development for your next film project.
Okay.
So this is a good strategy that a lot of high net worth people use. But again, if you're not making $500,000 in net income, that's not something you should be looking at.
Because our biggest thought process is like, what do you get in exchange for your tax bill, right? And so it's like, yeah, you can do all these cool things to offset your tax liability, but it's like, okay, yeah, I put money in this film. I don't really care about that. But what you're doing with real estate is like, instead of me paying taxes, I'm getting an asset that's adding to my wealth over time. And so for us, to the best of our ability, unless we've exhausted all options, we're trying to find tax strategy that is going to allow our clients to simultaneously build wealth at the same time, which is why we love real estate as a component. Like, we don't want to just chase tax strategy to chase that tax strategy. We don't want to just have to buy a G-Wagon every year or whatever the case may be. How can we grow your wealth and minimize your tax liability at the same time? That's the baseline. Anything above and beyond that, if we have to find creative ways to decrease your tax liability, great. But that's the goal, at least for us and our clients.
Yeah. Why should business owners be careful before forming an S-corp?
Well, when you become an S corporation, you have to operate your business like an actual business owner. So 2 things that most people don't know about when we have S corp. Number 1, you need to have an accountable plan, which states which expenses are you going to reimburse yourself as the owner of a business. If you don't have an accountable plan, some of your tax deductible expenses won't be tax deductible in case of an audit. Number 2 is paying yourself a salary. The easiest way to get audited is to have an S corporation and you don't pay yourself a salary, period. Almost guarantee you'll get audited. So you need to pay yourself a reasonable salary. That can be anywhere from 30 to 50% of the net income in your business. The more you make net income, the lower on that scale you can be. But you need to pay yourself a salary every single year, every quarter at least, to be an IRS regulation.
Got it. Anything against forming an LLC and then filing as an S-corp?
No, S corp is not an actual S corp is not an actual entity. It's an election status. You either go LLC, taxes as an S corp, or you go C corp, taxes as an S corp. You can't just go straight into S corp because it's an election status and not an actual entity.
Got it. Okay, that makes sense. What should one consider, or what should one know if you're a business owner out there prior to hiring your first employee? Hey guys, we are closing on our 6th boutique hotel out of the total 10 I'll be putting in a fund 1. So if you're looking for passive income, tax benefits, and diversification from Wall Street, My company, Summers Capital, is taking advantage of all the tightening Airbnb regs and the 40 million retired baby boomers. We do everything from sourcing the deals, renovating the properties, and even handling all the day-to-day operations, making it truly hands-off for our investors. If you want to learn more to see if we can help you, go to summerscapital.com/invest to book a free call with my team. Again, that's summerscapital.com/invest to book a free call with my team. Now back to the show.
Prior to hiring your first employee, I think understanding what your most important need in the business is, right? So if you're an entrepreneur and it's just you, 9 times out of 10, your first hire is going to be admin, almost like a catch-all, right? So for us, it's more about understanding the evolution of how you become more of the owner of the business versus the technician. And so first, it will be looking at what are all the administrative duties that I want to get off my plate so I can focus on the higher level things that I'm doing to grow my business. Then from there, it's like, okay, cool. How can I start to remove myself from fulfillment of the business, right? And then who is my next hire, right? And then from there, it's like, how can I remove myself from sales? How can I remove myself from marketing? You just kind of look at this pyramid of ascension to where you are more of the CEO and less of all the hats that you're wearing in the business. That's the way we would like to think of it, right? How do I make sure I'm hiring the right person at the right time who's going to fulfill the right responsibility for where I am in business at that particular.
Now, how about from a tax standpoint? Is it better to go W-2 salary, 1099, hourly, that sort of thing?
I mean, at the end of the day, having a W-2 employee is going to cost you more overall. But if they are working exclusively for you, like you don't want to play that game of like, ooh, well, let me try to hire him 1099 so I can avoid all this other stuff, because then that's another way to get audited, right? And so you want to make sure that at the end of the day, if they're working exclusively for you, you need to hire them as a W-2, right? But if you can avoid it and you can, hire them as 1099, that's fine. You're still going to get a tax deduction for the business, paying them. But more importantly, what I care about is making sure that you're not going to get audited because you're trying to pay somebody as 1099 to avoid paying them more, right? And ultimately you get audited because they're only working for you, right? So just understanding the role that they have in the business. Are they truly working exclusively for you? And that'll determine if they should be 1099 or.
What is the STR loophole? And I like to put a little spin on it. Boutique hotel also qualifies for this loophole. So what is the STR/boutique hotel loophole?
I love it. The short-term rental loophole is probably the best tax strategy for high-income W-2 employees and even high-income business owners. And the thought process is, if I buy a piece of real estate, usually without the short-term rental loophole, I cannot offset my active income with a passive income investment like real estate. However, if you have an average stay in that real estate property for 7 days or less, and you spend 100 hours or more working on that property, it's not passive anymore. It is active, which means that I can write off this active income against my other W-2 or small business income. So in a scenario, if we had a $500,000 property, we would do a cost seg study on that 25-30%. That's $150,000 write-off against our W-2 income. So this allows high income W-2 employees to get major tax deduction. But the thing I love more than the short-term rental loophole is the spousal loophole, right? So if you have a stay-at-home spouse, instead of allowing that stay-at-home spouse to be a stay-at-home spouse, they could be a stay-at-home real estate professional. We had a client that was a pilot making $400,000 a year. His wife was staying at home watching the kids. And so we said, if your wife becomes a real estate professional, gets a certain amount of hours studying real estate, managing your portfolio, you can now write off your real estate against this $400,000 in W-2 income you have as a pilot. So they end up acquiring 2 real estate properties that year, and we wrote off about $250,000 of real estate against his active income simply because his wife was a real estate professional. So no short-term rental, no 7 days or less. None of those rules have to apply because she was a real estate professional. So they both got to be a real estate professional.
In this example, because she's a full-time real estate professional, does the rental properties they buy, they don't have to be short-term rentals? They could be long-term rentals?
They could be long-term rentals. Exactly. So now you don't have to jump through the hoops of furnishing it, renting it out 7 days or less. You just long-term set it and forget it. She manages the property. She becomes a real estate professional. You both now have rep status, which is my favorite tax strategy for high-income W-2 employees.
Is it true that if you're a high-income earning W-2 and your spouse is a stay-at-home real estate agent, that you can use the depreciation also from real estate deals that you might own to not only offset the cash flow the real estate deal spits off, but also use it to offset your active income at your W-2?
Yes, if y'all filing married, filing joint.
Okay.
So yes, you could offset the cash flow and offset the active income via depreciation.
No one talks about this stuff.
I think because people don't know.
Yeah.
I'm actively looking for a spouse who's a real estate professional status.
That's what you're looking for, a spouse?
That's what I'm looking for. But no, it's just, again, the small rules in the tax code can make a dramatic difference in your overall wealth, because you cannot you don't have a lot to invest if you're continuously overpaying the IRS. Period.
How active does your spouse need to be as a real estate agent to qualify for this?
750 hours.
So it's okay. And so theoretically, you could argue that's doing 2 transactions a year, 1 every 6 months, right?
Yeah, I mean, think about it. If you get 10 hours, don't do public math. If you can do 20 hours a week, that's part-time, 52 weeks in a year, that's over 1,000 hours, right? So as long as you can commit them 15 hours a week to real estate, which I think anybody can, you can take advantage of the strategy.
Now, it has to be a rental property, right? It can't be a primary residence.
It has to be, to be a rental property. It cannot be a primary residence.
Now, you could buy it as a primary with little to no money down, and then 12 months later convert it to a rental, and then it will qualify?
Yes, but you lose the homeowner's exclusion. So we have clients that do this all the time, right? Which is why the overall wealth strategy is very important, because most people don't realize they get a $250,000 homeowner's exclusion or a $500,000 homeowner's exclusion, meaning if they sell the property for $500,000 in capital gains, but they live in it 2 out of the last 5 years, they don't have to pay any taxes on the sale of that property. But if you rent it out, you might lose that homeowner's exclusion because you're trying to get depreciation. So you have to look at the whole financial picture to not put yourself in an unnecessary bond.
Yeah. That makes sense. That's good stuff there. So next up, tell me if someone's listening to this right now and they're making $150,000 today, what's this fastest way for them to start playing the rich people tax game?
I'm gonna steal your thunder.
Let's hear
We
it.
should go there already?
Yeah, why not?
We want to hear all the thunder.
Yeah.
Okay, cool. If you're making $150,000 a year, you want to start paying the rich people tax game, this is what I would say. So we look at people like Elon Musk, right? And we say, okay, well, he did a leverage buyout of X, well, Twitter at the time, now X, right? And essentially what that means is he borrowed against an asset, right? And he used that money to then acquire X, right? Now, Elon Musk obviously owns Tesla. So people would think, well, I can't do that because he's a billionaire and he owns all these shares in Tesla, but Tesla is what? It's a publicly traded company. Because it's a publicly traded company, that means that the public, you and I, we have the ability to invest in these types of companies. And if that money was invested in a brokerage account, then you can borrow against the value of your brokerage account to be able to buy other assets. And so one of the easiest ways for the average person, or I guess 150,000 is an average, but the easiest way to play the rich man's tax game is to take your active income, invest it into a brokerage account, some of it at least, of globally diversified assets, right? Whether stocks, bonds, ETFs, whatever, and then identify other assets that you want to buy, right? So whether it's real estate, maybe I want to buy a business that I can own but do not run. Instead of me just taking money out of my bank account, I'm going to borrow against the value of my portfolio and then use that money to then go buy that asset. Now, why is that an important step? Because that money that's in my portfolio is going to still continue to grow and compound. And because I borrowed it, I didn't have to pay any taxes, and I'll use that money to go buy another asset. In this example, if I went to go buy some real estate with the money that I borrowed, now I'm buying this asset that's going to appreciate in value. Ideally, it's going to produce cash flow, right? And so then I can
You're going to pay down the principal. You're going to get
pay
tax
down the
advantages.
principal, take advantage of the cost segregation study, offset my tax liability, then take the cash flow, reinvest that back into the portfolio, which is going to allow me to rinse and repeat this strategy over and over again. Because the more money I reinvest back into the portfolio, the more money I now have to borrow against to keep rinsing and repeating this strategy. So that's something that, again, the everyday person can do today. Something that all of our clients, most of our clients take advantage of. You don't have to be Elon Musk and own Twitter own Tesla in the sense that he does, because you're an owner in the company by buying shares of it through your brokerage account.
We call that the refi and roll strategy in real estate game, man.
Love it.
Okay, so I want to switch gears here. You guys got a lot of videos on your socials that get a lot of engagement, a lot of views. So the first one I want to talk about is you talk about how to turn your birthday into a tax deduction. How do you turn your birthday into a tax deduction?
I love this strategy. So one of my mentors said, instead of spending money on your birthday, figure out ways to make money on your birthday, right? So one of the ways I make money on my birthday is I host a mastermind event with some of my most well-known entrepreneur friends so that we can develop strategies on how we're going to win bigger next year. So by having that birthday party be a mastermind event, I can rent out a big house in Cabo, spend $20,000 on the house, spend another $10,000 on food and decorations. And because it's a mastermind event, and if I can prove that it's ordinary and necessary to grow my business, which masterminding with my peers is, I'm able to turn my birthday, which would be a personal expense, into a tax deductible business expense. So I would be able to write off that $20,000 mansion in Cabo. I'll be able to write off 50% of the meals, the food that is catered to that event as well. And I will get to write off my flights to and from that location. And the best part about it is my business friends who are flying in, they also get to write off their flights for coming to my birthday because they're coming to a mastermind event. Now you want to make sure that you're actually talking about business. So the first 2 or 3 hours, we have whiteboards out, we have notes, AI note taker, photos for audit proof. And then after the mastermind is over, then we can party and have a good time, but we develop the business first. So this is how anybody should and can turn their birthday into a tax deductible experience.
Yeah. So like I just had a Tulum retreat. It was a mastermind event down there for all the members. And some of us flew private jet there and back. I did a podcast on the jet. We're talking business and that sort of thing. So in this example, that entire weekend is also a tax write-off?
Yeah, content is the best audit-proof mechanism because it's
Can't beat it.
you
Yeah.
can't beat it.
Yeah.
It has a timestamp when it was recorded, a
Yeah.
timestamp when it was posted, visual, and you can go back to the auditor and say, "Yo, this YouTube video, go to my YouTube studio. It brought me in $10,000. If that's not ordinary and necessary to my business, I don't know what is."
I'm gonna start doing podcasts on the boat.
Yeah,
There you go.
yeah,
go.
no, for sure, 1000%.
That's pretty cool. So in this example, birthday, you can do all the stuff. Just make sure it's a business event, mastermind event. I'll talk about leveling up, how to win in 2026, and that sort of thing. I like it. Okay. Next up, do not put these assets into a trust while you're alive. Which assets are those?
Yes. So number one is life insurance, right? Number two are your retirement accounts. And then number three are your bank accounts. We hear these quote like own nothing and control everything. Cool. I get it. But ultimately, one of the number one reasons why people don't end up keeping the trust is because they don't have it set up in a sustainable way. Like, because I call it the root and fruit system, right? Like anytime you see the fruit of something, you have to understand the roots that you have to dig in order to make it sustainable. And so when we think about having a trust on certain assets, we got to think about, okay, what is the practical functionality of how I'm using these accounts, right? So instead, with those accounts, we want the trust to be the beneficiary of the asset, right? So we don't need the trust to own it. We just need the trust when you die to receive the proceeds from those particular accounts. Because if not, when you still have those accounts on a day-to-day basis and the trust owns it, it just creates unnecessary paperwork and unnecessary hassle to actually navigate and use those accounts while you're living, when ultimately the objective is I want my trust to be the beneficiary of the assets anyway. And so that's why we recommend not having the trust own those assets. Now, the trust can own your business. The trust can own LLCs, right? All those things, right? But we don't want it to own those three assets.
Okay, that's really good. All right, so we talked about in the beginning the buy, borrow, and die strategy, but and that's for you guys. You think that's one of the number one wealth hacks? Yeah, I like that. Losers pay for the jet. What does that mean?
Well, first, me and him are just unreasonably competitive. We bet on everything, right? And so when where were we at? We were flying to one of our events.
Yeah.
Yeah. And so we were like, all right, well, why not just bet on who has to pay for the jet? Right now, full disclaimer, my record is like 20-2.
I win when it matters.
That's really good.
I win when it matters.
That's what he says. That's what he says.
Yeah.
But we played paper, rock, scissors to see who would have had to pay for the jet. And ultimately I lost, right? Now, the good news is it was a business expense anyway. So got a chance to write that off. But yeah, he won. It was documented. It was recorded. So kudos to
I love that. What do you guys normally bet on?
Everything.
Really?
Lunch.
Yeah.
You like NBA?
Ray-Bans.
Huh?
You like NBA?
Yeah. But we usually bet like, oh, who could do something better? So it's just a competition between me and him. But that's the beauty of having a business partner. You can turn most things that you're doing into some type of business related expense because we can have a meeting whenever we want to, right? Which makes, most of the things that we do together tax deductible, which is the goal. How can I, instead of giving money to the IRS, find out how to write things off so I can have more money to invest? And I think if more people knew how to do that, they'll put themselves in a better position.
In this case, it's more of a bragging right than a tax write-off.
Yeah.
We own the same business, so
Yeah.
whoever pays for this.
I love it, man. Everyone loves a healthy competition.
Yes,
Absolutely.
Yes.
absolutely.
So speaking of investing, how can one invest the same dollar 3 times?
Yes, we touched on it a little bit, but I'll break it down further. So, first, you want to set up your brokerage account. And the reason why we recommend setting up a brokerage account is because, unlike a retirement account, that allows you to borrow against the value of the assets inside of it, right? So, the fundamental difference being, if I have $100,000 invested in my brokerage account, Charles Schwab, Fidelity, whoever, they'll let me borrow probably up to 50% of that portfolio value, right? So the first step is I want to invest my money into the brokerage account. That could be, investing in Google, it could be investing in Meta, Tesla, whatever stocks make sense for your risk profile, right? Then step 2 is, while that money's growing and compounding, I'm identifying another asset that I want to invest in. Maybe I want to buy a laundromat, right? Like Cody Sanchez. Or maybe I want to buy something. I want to buy real estate like Rich, right? Cool. Once I've identified that asset that I want to purchase, instead of selling my shares, because people will say, buy low, sell high. The problem is, if you want to build generational wealth, you want to be able to hold assets for a generation. You don't want to sell them, right? So then you borrow against the value of that portfolio to then go buy that other asset, whether it's, like I said, real estate or buying a business. And then ultimately, in perfect world scenario, that asset is going to produce cash flow. And then we take the cash flow that it spits off and then we reinvest that back into the portfolio. So now your money's working for you in 3 different ways, all because of where you put it first. Because I could have took the money from my bank account to buy that, put the down payment on a real estate property, but now it's not growing and compounding anymore. It's removed from my bank account. Right?
And speaking of, the number one way I see a lot of people kind of trap themselves is they'll go put a bunch of money down on a primary residence, and that money's just stuck into this real estate deal. And I think primary residence is not really an asset. You got expenses, you got property taxes, insurance, repair and maintenance, HOA payment, all this stuff that people don't take into consideration. But because it's not an investment, you're typically not forcing a lot of appreciation. So you might not have a way to refi money out for quite some time. And there's a huge opportunity cost in doing that. So that's why, like, for me, I rent where I live. And for me, it makes a lot of sense because in San Diego right now, it's a lot cheaper to rent than it is to own, especially with the interest rate environment the way it is right now. And then I can save all that savings and go put that down on real estate deals that are going to pay me cash flow and get me a lot more depreciation tax benefits. And I have a clear path to force a lot of appreciation and kind of refi and roll that money over and over. But I think that's the number one way, at least I see people in my network kind of making that mistake, is they're putting all their money into a primary residence. Then now that money is trapped up, locked up, and they can't invest into other assets.
100%. Primary residence is an investment from the vantage point of your emotional well-being, right? The place of peace. You can raise your family there. It's a place to call home. But if we just look at the math objectively, it's not a great investment. It's not really much of an investment at all, right? Quite frankly, financially. But from an emotional well-being standpoint, if you're at a place where you've done the right things, you've invested it in other places, get your primary residence that you love, that you can host your family, host your friends. Now you can, of course, like we just did a team member event there at my house, right?
Oh,
You still can find ways to make it an investment, right? Leveraging the Augusta Rule, whatever the case may be. But ultimately, there's much better ways to invest your money than a primary residence.
What is the Augusta Rule?
Yeah, so the Augusta Rule, and for all my golfers out there, the Masters.
This guy's got the green jacket on already.
Yeah, happy accident, right? And so, the Masters is the flagship tournament in the PGA, right? That every golfer knows about. And a number of years ago, somebody wanted to rent their home out, right? But the IRS was like, no, you can't do that. And so when he found business use for it, ultimately now there's an IRS rule called the Augusta Rule. And ultimately what you can do is you can rent your home out for up to 14 days, right? And then ultimately, as the owner of that residence, you're going to receive that rental income, right, tax-free, and then it's a tax deduction for the business. And so imagine having a primary residence that, you can rent out for business use. And even though I own the house, right, my business had to meet somewhere, right? My team members, we had to meet somewhere. I said, hey, what would be the fair market value of me renting my house out at this time, right? Then ultimately, the business now has to pay me that rental income. That is tax-free income to me, and it's a tax deduction to the business. And now ultimately, I'm able to use my primary residence as an asset in that context while getting a tax benefit as well.
And is there a limit to how many times you can use the Augusta Rule?
Was it 14 days, right?
14 days a
14 days
year.
a year. Yeah.
14 days a year. Okay.
What most people don't realize about the Augusta Rule is you get to pick the 14 days you get to use. So I'm not using a random 14 days. I'm going to pull up the calendar of my city and see what are the biggest events that's coming to my city. We got Beyonce concert, we got the Super Bowl, we got big games. I'm going to strategically pick those 14 days when my city has the most foot traffic. Why? Because it's going to increase the rent comp that I'm going to have for that day. So I might have only been able to get $1,000 a day. But if I rent it out when the Super Bowl's in town, I might be getting $2,500 a day. So now I just 2.5x my deduction. So now instead of getting a $14,000 deduction, I'm getting a $20,000 or $30,000 deduction for leveraging the Augusta Rule. So a key we have our clients is pull up your city, pull up the biggest events, do the Augusta Rule those days to maximize your deduction.
So I have a luxury short-term rental out in Scottsdale, and it does very well year-round. Now, I like to do like one team trip a year out there. We'll go out there for 3-4 days, talk about work, talk about business, talk about planning and that sort of thing. And so maybe, or can I leverage this Augusta Rule with that short-term rental, even though it's a short-term rental the rest of the year?
The problem with that is the Augusta Rule works on your primary residence.
It has to be primary residence. Gotcha. Okay. So it would not work for that.
Yeah.
Got it. Okay. That makes a lot of sense. What are some of the tax benefits of buying a business? Because a lot of people talk about the tax benefits of buying real estate, but what are the tax benefits of buying a small business?
Yeah, so for high income W-2 earners, they usually only think that they can get tax deductions by buying real estate when they actually can get tax deductions for buying businesses. So if you buy a business that has assets on the books, let's say you buy a laundromat, but it has $300,000 of equipment on the books. When you buy that laundromat, you're also buying the depreciation that comes with that laundromat. So now I'm buying cash flow, but I also get to take advantage of that depreciation for all those assets. And depending on how the business does, I could have depreciation losses against my other active income at work. So we tell people you don't have to become an entrepreneur to save on taxes, but you do have to become an owner. And one of the ways you can do that is by buying an already established business that has equipment, and you can depreciate that equipment against your active income at work.
And to take it a step further, you buy a laundromat that comes with the real estate, and you buy the real estate too. Now you're getting the depreciation from all the equipment, the FF&E, but in addition to it, you do a cost seg study on the building, and now you get to write off all the depreciation against the building in addition to it. And by the way, the building probably go up in value over time. You can borrow against it, get your tax benefits, principal pay down, and some cash flow along the way.
Yeah. The best analogy I heard about money, shout out to Myron Golden. He said, the difference between poor people, middle class people, and wealthy people is not how much money they make. He said the difference between poor people, middle class people, and wealthy people is what they think the purpose of money is for. Poor people think the purpose of money is to give it away. So they make just enough money to pay all their bills. Middle class people think the purpose of money is to buy things that they can't afford to impress people that they don't like. So they buy expensive cars, buy expensive houses to put themselves in debt. Wealthy people understand that the only purpose of money is to use your money to make more money, period. So they take all their money and they invest it in assets. Then they borrow against those assets, tax-free, and then live off that. And then they buy life insurance and then die and then repeat the process. But what do you think the purpose of money is for? Is it going to keep you rich or keep you poor?
Dude, a lot of people tell me all the time, they're like, yo, Rich, I'm broke right now. I don't have any money. Cash flow's tight. I'm like, dude, being broke is part of the game. Being broke is part of the game. Look at Elon Musk. The dude freaking had a big exit early on with PayPal. What did he do? He turned around and shoved all the chips all in, betting on himself on the next thing. And he went broke doing it. But now he has Tesla. He's got SpaceX. He's got all these companies, Starlink, multi-billion-dollar companies. And look where it's got him now. He's one of the world's wealthiest human beings today. I mean, I'm not saying that you need to become Elon Musk, but the takeaway is like being broke is part of the game, and you have to shove the chips all in, betting on yourself, using your money to make money.
Facts.
I love that. I love that.
Riches is measured in money, but wealth is measured in time. Right. And wealthy people understand that I want to own my time. And so rich people, like wealth is an unexercised option, right? It's like you might not know how wealthy somebody is because you can't necessarily see it. Rich people want you to see it. Like, I got the land. And I'm not saying there's anything wrong with having those things, but they're putting their money in stuff, trinkets, toys. Wealthy people are putting their money in places that you might not even be able to see or know that they own it because they want to have time freedom. They want to know that all of my money or most of my money is coming from assets that I own that produce the cash flow so that whether I do anything actively or not, it doesn't matter. From my opinion, a true measure of wealth is your ability to say no, not your ability to say yes. Because you're typically having to say yes because you can't afford to say no. And so when you start putting your money in assets, going all in, betting on yourself, and acquiring these things that can produce the cash flow you need to maintain your lifestyle so that working becomes optional, that's when you've won the game.
Yeah, that's really good. I always say, figure out the life you really want, then say no to everything that isn't that. Starting is about saying yes. Growing is about saying no. You got to learn how to say no in this game. You can't say yes to everything. Question for you guys. You guys put out some content on like NBA player salaries. What is the NBA salary like? What is NBA salary taxes? I'm sorry, NBA salaries after taxes are insane. Break that down.
Yeah. So the unfortunate reality when it comes to NFL players and NBA players is they think they have more money than they're actually keeping. So on a $5 million salary, half of that is gone, depending on where you're playing at. Federal tax, state tax, self-employment taxes, city taxes, half of that is already gone. You have 5%, 5 to 10% in agency fees. Then you have to pay NBA dues. So you can, when it's all said and done, you could be looking at keeping maybe 37 to 40% of your money, but then you take care of all your family, taking care of all your friends. And now you don't have any money left over. So you thought you made $5 million, but you really like making 1.5 take home, but you're spending like you're making 5 million. And I think that athletes go broke, not because they're just financially illiterate. There's a big disparity between what their contract says and what they're taking home. And they don't realize that until it's too late.
Yeah. I had Golden Tate on, NFL Pro Bowl or Super Bowl champ, and he was saying like after the 35% that's really left over, I mean, even in his big contract years where he was doing, I think he had a couple contracts that were over 30 million. And he said even in those years, the 35% that was left over, it would all go to taking care of his boys, private jet to Vegas, taking everyone out, bottle service, nice dinners, splurging. And that money would just be really quick going out the door. And he said the money going out the door was more than he was bringing in.
And the problem with that is all the people you're spending money on, because of how big the lifestyle is, they can't help you recoup it. It's way too big for them. It's like, what do you want me to do? I make $100,000 a year, right? So that's the problem.
Yeah, it's crazy. It's crazy. But some of these guys are great at investing. Like LeBron, Kobe did good with his money. But then you see some of these other guys like Allen Iverson. He had a lot of money in his career. I believe the dude's got like a less than $1 million net worth today.
But one of the best things that somebody did for him is they set up basically like an annuity when he did his deal with Reebok. I think when he turns 55, he's gonna have a big lump sum of money that he'll have access to. But if he would have got all that money in the beginning of his career,
it would have been gone.
It would have been gone.
Yeah. Okay. That's crazy stuff, man. Guys, I appreciate you guys coming on the show and dropping so much game, so much value. When I'm out in Dallas next, would love to connect with you guys, get into your studio and pop in. Where can the folks get in touch with you if you want to learn more and also learn about your services?
Absolutely. So Melanin Money is the name of our company. You can find us on Instagram, YouTube, or just go to the website. You can follow our personal brands as well. George Acheampong Jr., sure to be in the show notes. Carter Caufield. And we typically, we like to do something called greatness on display. So what it does is we don't expect you to hire your money team without knowing if they can actually help you. So throughout the year, periodically, we do these things called wealth workshops, where for 5 days, we go over our top tax and investing strategies that have helped our clients improve their collective net worth by over $244 million in the last 12 months. And so people get a chance to essentially test drive what it's like to work with us for 5 days. If they like it, they can hire us, and then we can help them build wealth too and save money on taxes.
There it is. Anything to add, Carter?
No. The more you invest, the less you pay the IRS. So you got to find out how to maximize your money and minimize your taxes. And that's what we're here for.
I love it. There it is. They are Carter Caufield and George Acheampong. I'm Rich Summers, listeners. Thanks for tuning in. We'll see you guys on the next one. Peace.